Good afternoon. Welcome. I think His Excellency Tariq gave a nice precursor to what's happening in the region with the digital space, the real estate, the growth, and everything else. Let's talk now about the ground reality. How much are we willing to take, and how much are you willing to lend? And let's take a minute to introduce yourself. One of the key aspects I would like to target as well is what is the growth phase in your particular businesses, and what do you see as next?
The growth, we are very bullish, being in very active investors in the UAE. We strongly believe in the fundamentals of the economy, the vision of the leadership, and that is the catalyst behind our continuous investment strategy, which is now going towards Ras Al Khaimah. We believe that currently it's time to build, not to acquire ready asset, because of the valuation that is pretty high following the successful 2022. So it's time to build, and that's what we are doing. And we are simultaneously looking at different plots in different areas as well.
Yeah. It's time to go shopping.
Yeah.
Kapil?
Hi, so Kapil, Jobanputra, Standard Chartered Bank. I run the real estate financing business for Middle East and Africa. So thanks, Amit. Good to be here. I think just to address your question in terms of growth, I think there's been some excellent panels today and some really great content around the future of hospitality. And clearly, the Middle East has been an outperformer in terms of that ADR growth. And I think both the local banks and the larger international banks recognize this growth, and I think there is a lot of sentiment that this growth is sustainable, maybe not at the rates we've seen in the past 12 months, but definitely a long-term sustainable growth. And a lot of that is both bankable assets and bankable projects. Obviously, we can get into it in a bit more detail, but there are some challenges from a bankability perspective, but there are also some really great opportunities both within the hospitality and the broader real estate space within the region.
So we should ask you to come and underwrite our next year budgets as well.
We'll try. We'll try.
Zain?
Good afternoon, everyone. My name is Zain Qureshi. I spent 15 years working for Mashreq, and I looked after the real estate business. 10 months ago, I moved out, and I'm heading up a real estate advisory firm now. And the main reason I did this is because I truly believe that there's a huge imbalance between what we are developing and what we are looking to develop as a region, and the financial engineering that is there to support it. I believe that there's too much emphasis on a few avenues of liquidity, such as bank debt or sponsors' equity, and we do need to start looking at other alternatives in order to make it a more balanced playing field.
Vijay?
Good afternoon, ladies and gentlemen. Vijay Raghavan from Golden Sands Hotels, the Arinco Group. Long timer, about 26 years in Dubai and with the group. The market, thanks to the leadership, UAE in general and Dubai in specific, has been very good, and 2022 has been one of the most active years for our group. I mean, we have brought, and we are in the process of bringing more than 1,500 keys to the market on the Palm Jumeirah. So, yeah, exciting, but yeah, there are some challenges ahead.
So let's have some fun. So with the hard reset that we all have experienced, cost bases have been reduced to whatever. We still feel there's still a bit of fat, but I think when you compare it 19 versus 22, it's a paradigm shift in the way the businesses are operated. With all of that, what is the lending business, or how is the lending side of your business doing? opening the pie? Are you still chopping the pie in very small pieces, or there is still new pies being created for us to enjoy?
Lots of, you're making me hungry, Amit. With pie talk.
We are just before lunch, so we need to get to place.
No, so from my perspective, on the lending side, so at Standard Chartered, we have been in the region for many years as a bank, but from a real estate perspective, since 2010, we have been lending. I think within the UAE, we have touched most of the large-scale portfolios in some form, whether that's development finance, acquisition finance, corporate level finance, or whether that's on the capital market side. So the appetite hasn't, I wouldn't say, I'd say the appetite is very much there, with the exception of this period of COVID, where I think there was a state of confusion for both the operators and the lenders and the developers. And I think that hopefully that time is behind us for now. The challenge during that period is one for the banks, very much a regulatory one, where there was probably mixed guidance in terms of what you could do for clients when they were asking for concessions from the banks in terms of longer tenor, in terms of delayed interest and capital payments. So that created some level of hesitancy amongst lenders. And naturally, as a result of that, turning on the taps for new opportunities was difficult when you're trying to manage your existing portfolio. I think 24 months on, we are in a good position where the book has maintained a very strong position from a lending point of view. And sponsors have performed, right? And sponsors have been reasonable. Banks have been reasonable during this period. And I think there is an element of increased trust at this point in time, that if such an event was to occur, it would be handled better next time round. So very much bullish on the future.
And I think the valuations have helped. I think this year's valuation are going to put your books back in place.
Yeah, look.
In a very positive way.
So I think we're typically not, value-based lending is one sort of vertical, but very much it's about cash flows. Cash flows are there at the moment, and they are robust. So the question is, how sustainable are those cash flows, and are you underwriting your new debt recapitalization based on today's cash flows or based on the average of the last 2-3 years?
I think, let me ask this to Vijay, is that because you're not developing more hotels, you're wrapping up your existing development pipeline and you're opening them up. So how has the finance landscape evolved for you and your business over the last 3 to 4 years?
I think we are one of the longest standing groups that helps us. But yes, for the first time, the bankers took a back foot when it came to COVID, because we were all faced with complete uncertainty. But I think as the market evolved and we started growing, the bankers were coming back to the party for lending. And of course, for all of us who have almost lived for the past 12 to 15 years on a zero cost interest internationally, starting with the financial crisis. I think we are entering a new phase where we have to be adjusting ourselves to a 4 to 5% kind of Fed rate for a reasonable period of time, and that's a challenge going forward. Apart from the inflationary pressures on all other costs and the difficulty of recruiting and retaining talents, the finance cost is going to be one of the biggest challenges in the reasonable future to come. So we have to be conservative, we have to be careful. And as Kapil said, of course, the bankers would go back to their basics of not a valuation model, but a cash flow model, which is what is more sensible in these days.
Now, with the way finance has been progressive in this region, but one of the things that we don't see is intra-region financing. Zain, that has been kind of your specialty. That is what you bring into the game. Not happened so many times as it should have. What is the next? So because with all the developments that are happening, I think it's also about the risk appetite of the banks within the region of how much they can lend. But you have banks in Europe today who might have cash with the euro going down might not be the case as much, but still.
I completely agree with you. I think this is a emerging or developing market. For a lot of the banks, they're still learning how the game is played, how the deals are done. If you look at the way we looked at risk pre-COVID and the way you're looking at it post, it's completely different. Maybe the local banks or the international. There's emphasis on names, there's emphasis on track record, but there's a lot more emphasis on business models, on cash flows, on the repayment capability of those particular assets. As you mature into a more stable market, that's when the institutional investors and the foreign banks and liquidity providers basically come in. They are coming in. We've been talking to a lot of them. They are looking at different elements of this particular market. They're looking in Saudi. And I think it's going to be something which will hopefully catch momentum as we move forward.
But then what do you think is missing? Why, when we're speaking to His Excellency earlier, he was talking about the regulatory environment changing and everything else. What is the missing link? Because the cash is there. We have enough of investment appetite here for amazing investments, be it the ones that Khalid announced today or with any of the ones in Dubai wherein the yield ratio is through the roof. But still, you do not see that inflow of cash.
So if you look at 2008, 2009, when there was a global economic recession, asset values eroded significantly. There was a sharp downturn, especially when it came to the UAE. And that made a lot of the foreign investors and foreign banks shy off this particular part of the world. I think to a certain extent that is being addressed. But in addition to what Tariq was talking about, I think what we need is more clarity on law, more clarity on enforcement, ability for investors to come in here, enjoy the good returns, the strong returns that they're getting, but have the ability to get out of those particular commitments or investments without having to go through a long run when it comes to the courts and the law.
So, Khalid, now keeping all this in mind, you're going into a new development. I think this within your portfolio has been more on an acquisition spree of real estate. Land bank is kind of what you started maybe in a year or 2 years back. Now with this new phase, how are you looking at financing? How differently are you looking at financing? Are you deploying your own cash or what kind of ratios that you're looking at?
Look, considering the current circumstances and particularly the interest rate that is growing substantially today, in fact, they are discussing this in the US, the Fed, so they might raise another 75 basis points. The loan to value will need to be reconsidered. The tenor of the loan will need to be reconsidered. The debt service loan also need to be reconsidered. So today it will be more beneficial to put your own money rather than to borrow money, or rather than to put your money. We used to put money in banks and get interest from the bank. So today you are, in order to do that, it's better to deploy that money and reduce your LTV within that project. Just I want to come back to the discussion you had on foreign investment. Foreign investment, in fact, just I want to announce we are currently in discussion with a foreign group to join us in that project in Ras Al Khaimah with 20% equity on that project. The main reason that these foreign investors they are shy to the region, it's the governance and its lack of institutions. This is a family offices-based investment, and the market doesn't like that. So more we go with institutions, more you will see foreign investors come in.
And we see that when we talk to the Chamber of Commerce and Industry, when we talk to the economic development boards as well, they're encouraging, they're enabling, and even they themselves are doing road shows to bring different REITs, different institutions into, be it the Saudi, be it UAE, and I think that is happening progressively, not to the extent that it should happen, or we would like it to happen. One of the interesting things that you mentioned is about the interest rates, which is related to the inflation, and as we do not see where's the end of it. Yeah, be it the war in Ukraine, be it the end of COVID, but still it's not done and dusted. How do you see the lending environment as we move forward?
Yeah, so we just had a very good session with the economist just now, and we were discussing this at length, and it's a very complex situation that we're in at the moment, globally, both from an interest rate and an inflation perspective. And so when it comes to lending, clearly there are many unknowns. We hope that inflation comes under control next year. We hope that the current conflict is resolved sooner rather than later, and that supply chains start to open up, and that this energy and commodity price crisis cools down as well. Now, without having a crystal ball and knowing exactly how things are going to pan out, banks on the lending side need to take a slightly more conservative approach. And as Khalid said, I think making sure that you are future-proof so that your cash flows are sustainable and you're stress tested for an upside in interest cost. Yeah. It doesn't take a lot to actually double your cost of finance, right? It's it's a couple of %. So I think with that in mind, cost of finance, but also inflation in terms of cost of inputs. And I think fortunately we're a dollar-based economy largely in the Middle East.
Supports
but both costs and on the financing side, as well as your development costs, as well as your operating costs, I think all of these things need to be carefully considered before underwriting your capital structure in the future.
Now, the interesting part of when we talk about inflation and everything else, we still have enough people in the world who are willing to come to our part of the world and enjoy everything. As the announcement came yesterday, we have crossed the 2019 ADRs, rates, RevPARs, everything else. Yeah. When you look at the supply-demand gap that used to be, where we had an oversupply or a presumed oversupply, today it's not there because the occupancies, as we lead up to Q4, the hotels are packed, the rates are more than any time before because we have the willingness. The services offered here are next to none. How do you see it from an investment perspective? Is it a risk? Is it an opportunity?
Dubai has always said that we build and they come, and Dubai has proved it all the time. And with the quality of the property, with the quality of services, and as I think yesterday I presented, the pipeline supply is not as strong as it was in the past 5 years, and I think so. Overall, we are in a good place. Of course, there are challenges. The challenges coming out of strength of US dollar, which dents the demand from EU and UK were the prime markets for us, and the fact that in the last 2 years Dubai had the first runner advantage of opening the place far ahead of everyone else. But I think today, as Dilip was mentioning, sitting in the same chair, that even Thailand is open, the whole world is open. So that's another headwind. But I think with the kind of events which are planned for Dubai and the region, we should still be able to better our records of 19. And hopefully we'll even better the records of fourth quarter 21 and first quarter 22, which were historical for most of us.
Yeah. So, Zain, do you agree with it?
I do. I think the quantum of new supply coming on stream isn't that aggressive as it was previously. I think Dubai still has a lot to offer. If you look at the region itself, just macro for a second, we're expecting 100,000 new rooms in 5 years. 70% is coming in Saudi, 23% coming in the UAE, and the rest coming in the rest of the GCC. I think there's fair play as far as Dubai is concerned. I think there's a lot of interest for people to come over here and improve the capital stack of new and existing hotels. But again, going back to the same point, I think regulations and the legal framework have to be stronger.
And I feel that within the region, all the cities are not competing with each other. They're going to start complementing each other very fast. So the analogy would be that London and Paris don't compete with each other. They complement each other. Somebody goes to London for a holiday, travels to Paris, spends the same amount. If they go shopping, maybe a bit more, and they enjoy the space. How about expansion in the next 5 years? Khalid, are you looking to go in the same phase? Because the pace in which you went in the last 5 years has been amazing. With the acquisition of the MR portfolio, then other assets across the region, and now at Ras Al Khaimah as well. What is next?
Look, we will continue to expand in the UAE. We strongly believe in the leadership and in the vision. And we have seen, we have tried, tested, and it's sustainable. And we strongly believe that it will continue to be sustainable. There will be some hiccups on the way, which is normal, but on a long run is without doubt, I would say, the best region to invest in today. We will be as well looking to Saudi, why not, in certain resort areas. But all will depend on the rules, regulations, and reforms of the Saudi, investment landscape. But definitely, we continue to be very bullish, and we would like to continue to expand our portfolio within the UAE and within the region.
Vijay, how about you guys, from an expansion point of view?
Well, I think, as I said, we had the most active year in 2022. And we are always open for opportunities, both in terms of ground-up development or potential acquisition opportunities. As Khalid said, the couple of headwinds are the valuations, which are at historical highs in some of the property groups, and also the expected cost of finance. We will continue to look at opportunities, but cautiously, given these headwinds.
To the two bankers, now, we spoke a lot about the real estate of hotels. How about the real estate of restaurants, F&B space? This is a big evolving aspect of the market, especially if you look at the region in Riyadh or Dubai or anything else. Do you get requests to look into that asset class as a business of hospitality?
I'll quickly answer. Yeah, from my perspective, I guess it really falls under retail as a category in terms of restaurants. In Dubai, you have a lot of your restaurant concepts within or linked to malls or hotels. So when it comes to standalone restaurant offerings, to date, I think the risk has still been on long-term leases. So the property owner is separate from the restaurant operator, and ultimately there is a lease attached to that. But yeah, in cases where the restaurant is also the real estate owner, then I guess that sometimes becomes more akin to operating risk. But yeah, absolutely, it's a growing area within the region.
Yeah, I completely agree with you. I think it's the OpCo-CopCo model, where we primarily look at financing the mall owners or the retailers. The restaurants tend to not come to us. They're more looking at private debt and other alternatives of liquidity. But I think as this grows, it'll become more of ask going forward.
I think as we move forward also, there's going to be a big transaction space that is going to come up with all the IPOs and everything coming up. There's a lot of liquidity as well coming into the market. I think the oil prices also help. Yeah. So from a transactional model, what's happening in each of your businesses? Are you seeing more of requests coming to support any transactions, mergers, anything coming in the region? And even from I think in this region, we do not have that many operators. I don't see any Marriott-Starwood combination happening anytime soon. But are there any opportunities that I think it's open, any one of you? Do you see that happening around?
Yeah.
Look, there is certainly an interest in mergers and acquisition, not so much, but merger, yes, absolutely there are. But there are regional players that are looking to opportunities when it comes to merger. That not only in the hospitality, but also in our transportation business, as well as on the catering business. There is a strong interest. Yeah.
And you see this coming up in the next coming years as one of those
Absolutely,
new
yes.
opportunities as a lineup.
Absolutely, yeah.
Kapil?
There is, and for companies like us, it's a good way to consolidate and eventually to grow bigger through that model. Yeah.
Kapil?
Yeah, so I think that there's been, especially over the last 12 months, a fair bit of activity in the M&A space, and we are very active on a number of situations. And actually, Khalid kicked it off with the acquisition of the EMA portfolio, which we advised on a number of years back. But we are seeing that this is an opportunity for asset owners to take advantage of those high valuations. There's also a lot of liquidity that is looking for assets but can't find assets within the region. And there have been some more structured monetization type of transactions with things like the Jebel Free Zone and the port there, where we had a Canadian investor come in and acquire a stake in that platform. So again, to your point around cross-border investments, we're seeing investor flows come in, not to the pace that I think we will see in the future. I think it's increasing over time as investors get more comfortable with the legal and regulatory landscape, but also the cyclicality of the market. It has been cyclical in the past more so than other markets. And secondly, on transaction activity, we're seeing a lot of, given where regional liquidity is, we're seeing a lot of cross-border investment out of the region. So I think 50% of our deal flow over the last 12 months has been financing, Abu Dhabi sponsors, Saudi sponsors, UAE private family offices, Qatar family offices that are investing in both Europe, US, and Asia, and we're able to follow those capital flows outside of the region and finance on that basis as well.
Okay, and I think the weak euro definitely helps.
Indeed.
How about yourself?
Yeah, I mean, I agree with both the gentlemen. There has been a huge amount of activity. This is an attractive place to be in terms of investment returns, in terms of picking up assets which have strong business models. But at the same time, there are unique opportunities out in Europe, in the US, and Asia, and there seems to be a reasonable amount of volumes or liquidity going out to acquire those two.
Yeah. I think, Vijay, with your two beautiful hotels coming up, Taj already open, how are you looking at the next level of transactions in this part of the world?
Of course, Aramco is a largely diversified group, with the hospitality being one of the verticals. Apart from whatever we have done on the hotel side, we've been consistently growing even during the COVID period, be it manufacturing, be it on laundry services, be it on car rentals, and be it on our core real estate division. All of them actually saw some of the best years in the last couple of years. And we have been growing in all those divisions, and we continue to look at both organic growth and also growth by way of acquisitions where possible. So transactions, volumes, transaction numbers have been kind of on the ascent, even during these tough times.
I think
That's thanks to Dubai, thanks to the way they handled COVID, the way they gave confidence to the world to come back. And people who used to come and plan to come and live for a few nights in the hotel ended up actually taking up a villa and stay here forever, or buy a property where they can.
Yeah, and we have seen that across board, where from a financing perspective, a lot of things have evolved. It's not the traditional, 100% equity. You have a lot of debt coming in the market, a lot of structured debt, thanks to institutions like yours. A lot of acquisitions happening outbound, where the institutions have helped us. You guys have got some very interesting deals to a lot of our members, and I think that's been supported and valued. And within the region, in my opinion, REITs are here to stay. They're going to grow, and they're going to become a force to reckon with. We have 10 minutes for any questions from the audience. Yes.
I can see a hand up there.
The mics.
First of all, thank you so much for a well-needed session. After all these assets without finance will not be developed, will not exist. Actually, it's for all the panelists. You just mentioned about the REIT, and obviously we have structured finance as well involved. So we've seen a little bit of challenges with the REIT because banks are not in the region not keen for interest-only loans. And we've seen a lot of the REITs unable to distribute the free cash flow because with amortized loans, well, we ended up with a very unattractive yields.
Yes.
So it's a hybrid question. Where do we see that appetite from a banking perspective? Because that would definitely evolve the REIT market and definitely will encourage a lot of the investors and asset owners to go into the hospitality sector, especially if we know that hotels are lucrative, but has high level of operational leverage. So thank you.
I think, Kapil, that's for you.
Happy to, I think, thank you very much. I think, excellent question. So you're spot on when it comes to REITs, and I would say when it comes to high-quality commercial assets, actually, globally, seeing fully amortizing loans is not the norm, right? Real estate cash flows are perpetual cash flows, and it's not efficient for REITs to be amortizing loan when a REIT ordinarily looks to have a lower level of leverage compared to maybe if you're single asset type of mortgage. But lower level of leverage, but an ability to distribute on a consistent basis without having to pay the banks their capital back. So we at Standard Chartered are very much familiar with those sorts of structures. We do them all the time, bullet loans, but it doesn't work at 65, 70% LTV. So if you have a lower level of leverage, then it makes sense to have, and we bank, for your information, we bank REITs in Singapore, we bank REITs in China, we bank REITs in South Africa, and in the West as well. And the way they finance themselves is shorter tenor, bullet type structures, but also staggering their maturity profiles. And also a mix of bank debt and capital markets. So it is a hybrid of financing. And what's very important to note is that in a lot of these markets, there is a much higher level of liquidity compared to markets like these, where even during a period like COVID, where a lot of these REITs started getting quite highly leveraged, very quickly they were able to sell assets, and very quickly you can buy assets. And through an ability to deleverage and releverage very quickly, through asset sales or asset acquisitions, it makes banks more comfortable. So I agree with you that in a low leverage type of situation, you should be having bullet type structures. However, I can also understand why banks would want to de-risk slightly if it is kind of a high leverage type situation in more liquid markets.
Yeah. Thank you.
Hi, Amit. Hi, gentlemen. Great panel. You know what's coming. FDI, gentlemen. FDI, specifically transactions for real estate, hospitality transactions. There's now an increase around the world. US, we see an increase. Europe, we see an increase. Asia Pacific lacking a bit. But the eternal question is, why don't we have more FDI coming into the region, specifically Dubai, after we've proven ourselves to be one of the most resilient markets for hotels?
Thanks, Vinay. I think you should have asked Tariq on the panel before that, but he's sitting in front of you.
He's still around.
Yeah.
He's still there.
Tariq is still there.
I think, Tariq, you want to take it?
I think it depends on how you define FDI, right? So FDI in the sense of investing into employment, investing into some of those initiatives, there are a lot of companies that are doing that. But the large ticket items coming into the region, again, it's a combination, I think, of perception. A lot of investors only listen to and abide by the negativity that they hear. So no matter what regulation that you change, they're still focused on the one time that something bad happened to another investor, right? And so dispelling that perception is a big issue, but then also I think you need all the parts. The parts don't work very seamlessly here on an institutional basis. And it's not pointing at the banks, it's across the board, right? Whether it's the transferring of assets, it's the way the asset is owned, it's the way that you're financing it, it's how you're going to dispose of the asset. I think having that end-to-end visibility for the international investors is going to become more prevalent as these institutions here become grounded in a better, more robust framework of governance, institutionalization, and so on. But I do agree with you that there are major incumbents here in the market that I think some investors just think, I'm not going to be able to compete. So how can I join up with those institutions? And for the last few years, you haven't really needed to join up with institutions. It's been growing. I mean, let's forget COVID for a moment. So I do think that this will resolve itself at some point as banks become more comfortable, although you did say you're going to become more conservative, right? So as they become more comfortable with the asset classes, the longevity of the asset class, and the type of investor that's coming in. But I agree, relative to what has been invested today in the market, the component of FDI is quite small, but if you study it over the last 10 years, it's actually become more substantial on a relative basis and on absolute basis in the market.
And just to add to that as well, this region has been a very conservative market from an FDI perspective because there was enough capital within the region to fund anything and everything that we were doing here. The valuation of oil definitely helped to provide more liquidity, but now it is the time, and I think FDI is the way to go, wherein you do cross-border assets and investments, and they're definitely here to support everything that the banks are doing, the real estate investments where will be a generational change, and I think that will open things up a lot more as well. Yeah. Anything else? Anybody else? Hey, thank you.
Yeah, everybody's hungry.
Thank you for such an amazing panel.
Thank you.
Yeah. And
Thank you for having us.
thank you.
Thank you. Thanks, Zain.